The burgeoning world of cryptocurrencies has captured the imagination of investors seeking alternative wealth creation opportunities. Among these digital assets, Ethereum, ETH, has established itself as a prominent force, captivating minds with its potential to revolutionize how we interact with data and value. Now, with the emergence of ETH exchange-traded funds, ETFs, a captivating new pathway opens for investors to gain exposure to this innovative technology without directly navigating the often uncharted waters of cryptocurrency exchanges. This article delves into the intricacies of ETH ETFs, dissecting their workings, exploring their potential advantages and drawbacks, and ultimately offering valuable investment insights for those considering venturing into this nascent financial territory. Understanding ETH ETFs, bridging the gap between traditional finance and crypto. An ETH ETF, like its traditional ETF counterparts, tracks the price of an underlying asset, in this case, the cryptocurrency Ethereum. However, unlike ETFs that directly hold stocks or bonds, an ETH ETF does not physically own ETH tokens. Instead, it typically invests in Ethereum futures contracts, which are agreements to buy or sell ETH at a predetermined price on a future date. This approach offers several advantages for investors. Firstly, it mitigates the risks associated with holding ETH on individual wallets, including hacking, loss of private keys, and exchange security concerns. Secondly, it simplifies the investment process, allowing investors to access ETH through familiar brokerage accounts and traditional trading platforms. Additionally, ETH ETFs provide greater liquidity and potentially lower transaction costs compared to direct cryptocurrency trading. However, it's crucial to understand that investing in an ETH ETF comes with its own set of considerations. Unlike owning actual ETH, which grants voting rights and participation in the Ethereum network governance, investors hold shares in the ETF, which may not confer these privileges. Furthermore, fees associated with the futures contracts and the ETF structure itself can potentially erode returns. Investment insights for navigating the ETH ETF landscape. With a growing number of ETH ETFs emerging, selecting the right one requires careful analysis and consideration of several factors. 1. Underlying exposure. Different ETH ETFs employ varying strategies to gain exposure to Ethereum. Some rely solely on Ethereum futures contracts, while others diversify by incorporating Ethereum derivatives, options, or even physical ETH holdings. Investors should align the fund's underlying exposure with their own risk tolerance and investment objectives. 2. Expense ratio. The expense ratio, which denotes the annual fees charged by the ETF, impacts overall returns. Lower expense ratios are generally preferred, but investors should also consider the value proposition offered by the ETF, such as additional services or unique investment strategies. 3. Liquidity and tracking error. A highly liquid ETF ensures ease of buying and selling shares, while a low tracking error signifies how closely the ETF's price reflects the underlying asset's performance. High liquidity and low tracking error generally translate to a more efficient and reliable investment vehicle. 4. Regulatory landscape. The regulatory landscape surrounding ETH ETFs remains dynamic and varies across jurisdictions. Investors should stay informed about existing and potential regulations impacting ETH ETFs in their chosen regions. Beyond price, potential for broader market integration. ETH ETFs represent a significant step forward in integrating Ethereum into the mainstream financial system. This integration offers several potential benefits. Increased institutional investment. ETH ETFs potentially attract institutional investors who, due to internal policies or risk concerns, may have previously avoided direct cryptocurrency exposure. This influx of capital could bolster Ethereum's long-term stability and growth. Enhanced market stability. ETH ETFs introduce new avenues for hedging and portfolio diversification, potentially leading to reduced price volatility and a more mature Ethereum market. Greater global adoption. Increased accessibility through ETFs could accelerate Ethereum's global adoption, paving the way for broader real-world applications of blockchain technology. However, it's important to acknowledge potential challenges alongside these opportunities. The nascent nature of ETH ETFs necessitates ongoing regulatory refinement and investor education to ensure informed participation and safeguard against market manipulation. Additionally, the inherent volatility of the cryptocurrency market should not be underestimated, requiring investors to maintain cautious optimism and robust risk management strategies. Investing in ETH ETFs, a calculated leap into the future. Investing in ETH ETFs carries both promise and peril. For those seeking exposure to the burgeoning potential of Ethereum, these instruments offer a convenient and familiar entry point. However, careful consideration of underlying exposure, fees, liquidity, and the ever-evolving regulatory landscape is paramount. Ultimately, success hinges on a solid understanding of the technology, responsible investing practices, and a healthy dose of caution amidst the alluring, yet volatile, world of cryptocurrencies. As the technology matures and regulatory frameworks solidify, ETH ETFs have the potential to bridge the gap between traditional finance and the revolutionary potential of blockchain. For the discerning investor, navigating this frontier with thoughtful exploration and calculated risk-taking presents an exciting opportunity to participate in the shaping of a new financial future.